1999 versus 2025. Every single person in the financial world is calling for a stock market crash, is saying that right now is just like 1999 and we are going to see a massive meltdown. Maybe we do and maybe we don't, but one thing that we do know for sure is that we have the charts of right now versus 1999. We have the data, we have the economic news, we have the valuations, and we have the calculators to figure out right now, how does the stock market actually look? And of course, how can we freaking make some money off this stuff, guys? I'm here to make money. You're here to make money. Let's do it. All right, so let's dive into the charts first. We'll go through the fundamentals. We'll go through the valuations. We'll go through the earnings growth. We'll go through that calculator at the end that's honestly pretty sweet. We're going to plug in a few different numbers into it, and it'll spit out a value that the S&P 500 should be at right now. And it's honestly pretty shocking, but I'm not really surprised at what it's spitting out for us there. So let's just start off here. If we look at coming basically from 1994 to the top of the market bubble in 1999/2000, you can see that the market pumped roughly 244% in just under 10 years. Did that massive pump going up? Yes, there was 20% corrections on the way up, 20% here, and there's a 15% one right here. But, that's all just building into the backbone of how this bubble really materialized so hard. And then you could see what obviously followed. It was roughly a 47% crash. And if we just think high level about this, it's like, how can the market be so wrong to blow things so far out of proportion on the upside and then blow it so far out of proportion on the downside? You're going to be like, isn't the market efficient? Isn't all the public news priced into the stock? How did this actually go down? And the thing about it is, humans don't change. 1929, the market saw a similar crash like this. Obviously, in 1999, the market saw a crash like this. And maybe we're going to see a crash like this in the coming years. By the end of this video, I think we'll have a pretty good thesis on what is going on in the market. I realize my last few videos have been kind of bearish and saying, oh my God, the market's overvalued. But it might not be as clear as what it seems, and there still might be a lot of opportunity out there. So let's look a little bit deeper here. You can see we fell 47%, a lot of bumps along the way. And then if we go to the current chart right now, it's a similar duration of time on the x-axis right here. You can see that we had a 24% correction coming in 2022. We had a 20% correction this year. But again, look at how much the market moved from top to bottom. 231%. Kind of rhymes a little bit to what happened in the dot-com crash, 244%. And keep in mind, this is for the S&P 500 for both charts right here. So just by looking at this, yes, it's only a chart. Sure, Brandon, the market moved up a lot, but so did the earnings. The earnings went up a lot too. So doesn't that justify the valuation level that we're at right now? Maybe or maybe not. And I have a pretty good argument for both sides. And honestly, I want you guys to comment below, what side of the argument are you on right now? All right, so everybody likes to talk crap on Warren Buffett, and let me get myself out of the way here, because everyone says, oh, Warren Buffett, he's old and he doesn't know what's going on and he's not with the times and he doesn't know about tech and this and that. But my argument to you guys is this. I know that pretty much nobody watching this video is worth over $200 billion. And if you are, pretty crazy, but I know that you're not. So we have to listen when Warren Buffett talks. It's not the end all be all, but if we look at the Buffett ratio versus forward price sales, this is basically showing you how expensive things might be right now. And this chart goes all the way back to roughly 1950. And you can see that right now we're pretty much at all-time highs, pretty much topping out what was happening in 2021 and even surpassing what was happening in 1999. So maybe the drop that we had in the stock market right here for 2022, maybe that was just a little mini correction building into the big bubble that might be forming. Remember, there was mini corrections of 20% that happened in 1999 leading up to that bubble, forming the big bubble that actually had the big blow off top. So maybe that's what this is building into. And if you just look at how this is calculated below, it's the total value of U.S. corporate equities at market value divided by the nominal GDP. So it's basically just the value of the stock market divided by the gross domestic product. And it's basically saying, look, the market is a little bit hot. But this is just one chart, and we can't really base our whole conclusion on just one chart saying, oh my God, the market's hot, we got to sell everything. It's not that simple. So this is a pretty good chart from JP Morgan Chase. And actually, before we dive in, I do want to say something here. And it's this idea that everyone talks crap sometimes and says, Brandon, you're so heavy on valuations. What about momentum? What about the charts? What about technicals? What about AI? And I'm like, I get it. Short-term valuations don't matter as much, but in the long term, the stock market is a weighing machine. It's going to put the stocks on a scale and weigh them and say this is what they're probably worth. But in the short term, the stock market's basically like a voting machine. Sometimes it votes that Palantir is worth way more than what it actually is, and sometimes it might vote that United Health, when it fell, is worth a lot less than what it's actually worth. So the stock market in the short term is very volatile, it's very bouncy, and it doesn't always correlate to what the actual underlying business is actually doing. If you just go on YouTube and type in Jeff Bezos, you could see him talking about what happened to Amazon stock in 1999. He was saying going into the pump, the stock was going totally out of control, and we're looking at our balance sheet and our cash flow statement like, our company is not doing this well. And then when the stock was falling like 95% when a crash started to happen, he's looking at his cash flow statement and saying, our company is growing. Our company is bigger and better than it was 5 years ago. Why is the stock down 95%? And it's basically just fear and greed of people pumping into everything with a .com behind the name and then dumping it when it went out of style. So maybe in the short term, everything with AI is hot and exciting, but maybe in the long term, it's not going to be as exciting as what we actually think. Yes, there's going to be big winners like NVIDIA and AMD and TSM and Meta and Google and Tesla. Those companies are probably going to win a lot in this AI cycle. But the thing that it comes down to is good company versus good price. It's two totally different things. So let's dive back into that chart here and take a look. So if we look on the bottom, you can see it goes from 1994 to basically current price earnings ratio levels on the y-axis. And this is the forward price earnings ratio level. So it's factoring in earnings that haven't even happened yet. These are earnings that are going to come 1 year from right now. So if we just take a look very high level and very simple, the 30-year average for the price earnings ratio level is 17. You can see that right now we're at 22.8, a little bit expensive, pretty much in line with what it was back here in 2021. And of course, we all know the stock market fell like 30-ish% back then. So maybe we're in a similar situation as that. Maybe we're just going to have a 20% correction. The market will go down, earnings will catch up, and everything's going to be all good. But maybe not. What if the stock market actually falls to one standard deviation below what the average price earnings ratio level is? Because people talk about this base case of, well, what if the market just falls back to a PE ratio of 17? It's going to be all good. But what if it falls below that? Like, what if things actually go on sale and get super cheap? What is the market going to do then? We might be looking at a 30, even 40% stock market dip. And you could kind of see that exact psychology of fear and greed played out in 1999. We went over one standard deviation above what the average PE ratio is up here, but then you could see the market corrected way lower than what the average PE ratio actually was, over one standard deviation below what the average PE ratio level was. So you could see super euphoric, blow off the top up here and be extremely greedy, and then super fearful, super pessimistic, everybody's freaking out, they don't want their stocks, sell them, take them, get them out of my portfolio. That's what was happening right here. So the time that we're in right now, yes, it's expensive, yes, it's hot, but it is not as hot as what's going on in 1999, but it is close. If earnings continue to grow, I think that the show's going to go on because nobody knows when this is going to happen. I mean, let me just flip back to the chart real quick. Look at how many years it took for the market to actually crash when we were at a higher valuation level. Like if we just say, oh, once the market goes above one standard deviation, it deserves to crash. But it really didn't, because if we just go down, this is 1998 when it actually crossed, it took almost 3 more years until the market actually crashed. So right now, maybe we're going to have 3 more years of a bull run, maybe 2.5, 3 years, whatever this ends up being, and then the market crashes. But in those 3 years that the bull run might continue, heck, what if the market doubles in that time frame? And if you're sitting on the sidelines in cash, you sure are going to look pretty stupid that you didn't capitalize on all this upside right now. So that's why I talk about this idea of be positioned for upside and downside. Don't have all your eggs in one basket, but also if the market goes down, you're going to be positioned perfectly to capitalize on the dip. I actually have things in my portfolio that if the market goes up, they're going to make money, and if the market goes down, they're going to make money, and you're going to be like, that investment does not exist, Brandon. And honestly, it does. And if you want to check it out, get in my Discord below. It's 100% free for the first couple days. Check it out, free trial. But let's go into that calculator to really figure out an exact price level that we feel like the market should be trading at right now. And honestly, it's not going to be too pretty. So let me get myself out of the way, and I call this the intrinsic value calculator. And if anybody has read the book, The Intelligent Investor by Benjamin Graham, This is Benjamin Graham's revised formula. And if you look up here on the top, this is how I have it all put together for the sheet. And then also this is obviously the formula and what everything means within the formula. It's honestly a decent thing to have a baseline gauge of what something should be trading at right now. So we're going to start off with the stock of VOO. That's obviously the S&P 500. Now the earnings per share, I did have to interpolate. And basically what I did was I took the share price and divided it by the price earnings ratio level. And that's how I came out to the earnings per share. PE of company with no growth is going to be 7. That's going to be a constant. Growth rate for the next 5 years is going to be 8. And you're going to say, how am I coming up with 8? Well, if we just take a look on FactSet right here, they're basically saying earnings growth for Q3 2025 estimated year over year is expected to be 8%. I do think that's pretty accurate, and I don't think that AI is going to really swing this much higher or much lower. This is typical for the S&P 500 to grow at roughly 8% year after year after year on an earnings growth basis. The average return for the S&P is roughly 10%, but that's because there's roughly a 2% dividend yield, so that's how you get to the 10%. So we're going to use 8% for our calculation right here. And 1G is a constant. Average yield of a AAA bond is 4.4. That's average over the last 50 years. And then I'm putting in 4% for the current yield on AAA bonds right now because it's right around 4.5, but yields are expected to fall. So I'm giving the benefit of the doubt to the valuation level of the market because a 4% yield is going to make the intrinsic value actually a little bit higher for the S&P 500. So you can see $390 is the intrinsic value for VOO, which is the S&P, and the current price is $615. So if we just divide that out, that's basically implying that we're going to have a 36.6% stock market crash. Obviously, it's not going to be exactly 36.6%, and honestly, it might not even happen. This is just one calculator of me plugging in numbers that might change, but it does give us a baseline idea right now of where we're at. You could obviously see we're a little bit expensive. It might not be a bubble where it's expected to fall 75%, but it's also not super undervalued either where it's oh my God, we need to go buy right now. So the overall view on the market, yes, things are a little bit hot, but the show continues. As long as earnings keep going up and we have Q3 earnings coming right around the corner, I'll be breaking all that down in Discord in real time. Do my course, come in Discord, 100% free below for the first couple days. It'll honestly change your life. So Q3 earnings are probably honestly one of the most important reports that we're going to read in probably the last couple years, in my opinion, because the market right now is at a tipping point of, is AI hype? Is AI bubble? Or does the show keep going on? If I had a crystal ball and I'm forced to tell you what I think the show is going to continue. But when we get a sign of slowdown on CapEx or AI or really any guidance going forward from the big companies, the market's going to take a little bit of a breather. And to be honest with you, that's okay. Most of us, we probably doubled our accounts since April. It's okay to give a little bit of that back. And if you want to see a really good video of Jensen Huang breaking down the actual demand for NVIDIA and AI going forward, I just broke it down a couple days ago from his most recent interview. I do think you'll get a lot of value from it. Check that video out right here. Don't forget, like and subscribe, and I'll see you guys later.